Defense stocks as a basket has outperformed recently in light of the ongoing Russia-Ukraine war, geopolitical risks and sudden push for indigenization and the relatively undemanding valuation. While the re-rating in recent times has been influenced by these factors, defense could still be a long-term play. Some of the stocks still offer good value, particularly in the light of the government's indigenization program. India imports 65 to 70% of its defense requirements, and 65 to 66% of that comes from Russia. However, in the backdrop of Russia-Ukraine war and with the aim to create jobs in the domestic economy and save precious foreign exchange, the government has embarked on restricting import of defense products. Over the last 2 years, the government has issued 3 lists of items that cannot be imported, taking the total to over 310 items or products which will now be manufactured and procured by the government from the domestic market. It is estimated that the negative list itself will offer close to 4 lakh crore worth of opportunity for domestic market over the next 4-5 years. This has opened up a huge opportunity for domestic players to expand their base and scale businesses, particularly the companies in the PSU space which already have approved technology, products, processes, and facilities from the DRDO and other organizations. The share of indigenous procurement, which stood at 54% in FY20, now stands at around 66% and is expected to move up with the announcement of the new lists of items that are restricted from import. We often saw lumpiness in the revenue and profitability of defense companies. However, with the government opening up the sector, geopolitical risks, growing security concerns over the long term, and urgent need for upgradation of defense establishments, certain amount of predictability is returning. Except for COVID-led issues, the awarding of new projects by the government, procurements, and timely payments are likely to support growth. What really matters is the quantum and certainty of earnings. These companies, particularly the PSUs, are sitting on huge orders that are supposed to be delivered over the next 4-5 years, providing strong revenue visibility. On a cumulative basis, they have a total book of around 2.5 lakh crore, which is over 5 times their annual revenue. The cumulative market cap of these companies is merely 1.5 lakh crore. Interestingly, the market is getting more convinced about growth and certainty of earnings. Last 1 year, despite the stress in the engineering space and COVID-led issues, defense companies have delivered strong revenue growth, and the credit goes to strong execution and deliveries. Moreover, execution is improving with every passing quarter and has reached pre-COVID levels. In December quarter, the cumulative revenue of these companies grew 24% YOY and profits by 32% as a result of margin expansion. Companies have indicated that the momentum in growth will continue in the light of easing bottlenecks, higher execution, strong order book, and timely deliveries and payments. Even though stocks have rallied, valuation in many cases is still reasonable in the light of the strong earnings visibility. Among the stocks covered by us, Cochin Shipyard, Bharat Electronics, Hindustan Aeronautics, GRSE, and Mazagon Dock remain top ideas. Bharat Dynamics is equally promising, but given the strong run-up in the share price and valuations, investors should be cautious in the near term.